Okay, so we're going to spend a little bit of time talking about what the option indicators are saying regarding the market. Um, just a little background. We started out originally as a derivatives research company, selling research newsletters, recommendations, etc. We moved into money management in 2008, both as a CTA on the future side and an RIA on the regular option side. And we also do a certain amount of educational things like this webinar or mentoring, that sort of thing. So I'm going to come back to this later, but we will be sending you the PDFs of this webinar. And by PDFs, I mean one will be in color and one will be in grayscale. But I'll come back to this offer. We're offering our top newsletters for a very low price. So mainly we look at these four things, although as you'll see, there'll be some additional nuances to some of these. But first and foremost is the chart of the S&P 500. That's the thing we're all trying to figure out where it's going. So that's the most important indicator that we have. Then we'll take a look at equity-only put-call ratios and also put-call ratios on individual stocks. We'll take a look at market breadth, where we have some option-oriented ways of looking at that. And then finally, we'll take a look at VIX and some other things surrounding VIX that we use as pretty accurate market predictors. So my most important rule really is that oversold does not mean buy. If a market gets oversold, it can stay oversold for a long period of time. And there's a corollary to that, which is that overbought does not mean sell. So right now, we don't really have much that's oversold, but we are starting to see some things that are overbought. But just because it's overbought, in fact, when the S&P is breaking out to new all-time highs, sometimes it's good to have things be overbought. That's showing that the market is participating heavily along with the rally. So here's the two-year chart of the S&P 500. The blue trend line I have there on the bottom just extends back to the lows of October of 2023, but the real this bull market started in October of 2022. We had a couple of ordinary 10% corrections along the way, just kind of garden variety things back there in the fall of 2023, and then again last August. But then we had this monster correction here based on the tariffs, the scare of the tariffs anyways, in August. And it came about because we made new all-time highs in February, but really just by a little tiny bit, and then again by just a little tiny bit. And eventually those failed. They were false breakouts. That's never good. And when we did finally break down through support here, it snowballed into a monster correction of over 21%. In just 37 trading days. We've regained all of that, and that's pretty amazing in such a short period of time. And so now we're all the way back at new all-time highs, and this time I think it looks a little stronger. The internal indicators are stronger than they were back in February. So I'm thinking we should be able to hold these new all-time highs. Of course, one never knows for sure. That's why we continue to follow the indicators. This is a one-year chart. The only really interesting thing that's added to this chart is the fact that I've marked several gaps on here. In fact, 4 of them. Those are the circles. There's a couple of other gaps that have been filled. For example, we had one just last week right there that was filled. I wouldn't say that all those gaps are going to have to be filled. It's just sort of indicative of the modern market that we get all these gaps in. Eventually, some do get filled. Like if we go, back here, farther back, we see, that one got filled. Took a little while, but this one here got filled. So I'm not really expecting those to be filled now. But the support levels, the first support level is that gap all the way down from 60.60 to about 60.20. And if we filled that, that would be okay. I wouldn't, be a little surprised to see that. But if we broke down through 59.20, which is the second red line here on the chart right here, then I'd pretty much say that with this, we had a false breakout. I don't expect that to happen, but there's a point right there where if we fell back that far, I think you'd have to at least turn neutral, if not bearish. So this just sort of summarizes those support levels are 60-60, that's the top of that gap. 60-20, that's the bottom of that gap, and then 59-20. So this chart is bullish. Obviously, anything breaking at the new highs is bullish. I know a friend of mine used to say that the Wall Street Journal publishes a list of the greatest momentum stocks every day. It's called the new high list. And that's sort of true. If you're just concentrating on those, you're probably going to be in some good, strong upward momentum. So there's one other thing we do with the S&P chart, though, and that is what we call modified Bollinger Bands. So when John Bollinger invented Bollinger Bands, he used the definition of realized volatility to be the standard deviation of closing prices. And that seems reasonable, but that's really not what the Black-Scholes model uses or other other mathematical indications. So the Black-Scholes model, in fact, uses the standard deviation of daily percentage price changes. It's just a slightly different number, but we're in the option business, and so we need our realized volatilities to correlate with implied volatilities, and we're using basically the Black-Scholes model to generate implied volatilities. So if you want to compare realized, we need to calculate the same way they do. So we are doing that. And so when we draw the Bollinger Bands using that definition of volatility, they're in a slightly different place than they are as a standard Bollinger Bands if you were to look up the definition in Wikipedia or something. Anyways, so we watch for the market to move outside of either the plus or minus 4 standard deviation band. That gives you a very extreme overbought or oversold. And then when it moves back inside, that gives us a signal. So we traded it just that way for a while, but there were a lot of whipsaw signals. So we refined it a little bit to create what we call McMillan volatility bands, or MVB signals. So here's the current chart of the S&P, that same chart, but now I've drawn these bands on it. So the top band up high there, that's the plus 4 standard deviation band. Well, let's see if we can. Okay, here, right here. That's the plus 4 standard deviation band, and then the one right inside it, that's 3 standard deviation. Now they're pretty far apart there because the market was so volatile. Now, if we look over here where we are currently, they're much closer together because realized volatility has calmed down a lot. But you can see, for example, just move over to the left side of the chart so it's clear. We're outside the 4 standard deviation band and went inside the 3. So that gave us this sell signal right here. And ideally, it would then move to the lower band, which it did, and that completed a successful sell signal there. In fact, it gave us another signal, a buy signal, by moving below the minus 4 standard deviation band and then inside the 3. And that buy signal lasted for a long time. We never really went above the plus 4 standard deviation band again. So when we're trading really any of these things, I'll talk a little bit more about that in a minute. But we roll our options up. So that position that we had established, say back last August of 2024, after that correction, we rolled that position up several times. Now you can see a couple of these are blue letters. Those were failed signals. So we're here. We moved below the minus 4, inside the minus 3, but we never really rallied much, just a little bit, and we started to fail there, so that stopped that out. We did have a good buy signal here after the April lows, and then just recently, well, not all that recently now, but a few weeks ago, we got a sell signal up at on the upper right of the chart there, right here. And that one didn't work out. You can see we're above the 4, went below the 3, and now we just sort of worked our way higher. But now another one may be setting up. I say maybe because the first thing that has to happen is we have to close below this 3 standard deviation band right there. We did not do that today. But even if we do that, that's still not a sell signal. We have to have a little further movement before we would actually get the sell signal. So it's potentially setting up. It's an overbought condition, but as I said, overbought does not necessarily mean sell. So just to summarize that, we're setting up this sell signal right now, but it's not guaranteed. If you get a chance, or when you if you take advantage of the offer I'll be talking about later, the Option Strategist newsletter has a long track record of these signals, especially the ones on the S&P 500, and it's been very profitable over the years. So you know, it's not, I don't really ignore any of my signals anyways, but this is certainly one that if it were to materialize, I would certainly take it. So this procedure of drawing these bands can be done on any chart, any stock, any index, any futures contract. So we actually offer a subscription service that does that. And the service looks like this. It runs on TradingView. So this is the S&P, the one we just we're talking about. You can see we're outside the band here. I drew this chart this morning, so it's got a partial of today on it. Here was that failed sell signal there, but then the more successful buy signal, and then of course the ones earlier just on the chart we looked at before. Now the TradingView software puts these triangles on there, the red and green triangles, not the circles. I drew those myself. But just to show you, this is the silver ETF, and we had a really nice buy signal down here in the beginning of April. It rode it all the way up, and then it finally hit the upper bands, and we stopped. We took the profits on it there. Now a new sell signal is set up right here. It's still going sideways. You might want to see if it breaks down below 3250 there, and then you know, before acting on that. But a sell signal has set up in the silver ETF. This is Coinbase. Coinbase, I wouldn't say the signals are all great, but there's huge movement when you get it. So if you're trading options, you know, you're only risking the price of the option. So you can control that, and if you get one of these big moves like this, I mean, that buy signal took place there, hit outside the band there, but it technically still going. So if you're rolling your options up, you'd still be in that one. And then just one more. This is Disney. It just gave a new sell signal. So again, that's not every sell signal has worked all that great in Disney, but you know, this one just occurred, so I'm just showing you that. All right, let's move on to the next subject, which is put call ratios. And put call ratios were invented as a contrary indicator by Marty Zweig back in the 1950s when he got the option volume out of the ads that ran on Sundays in Barron's from the put and call dealers of those days. There were 6 or 8 major ones. And he'd add up all the calls that traded, add up all the puts that traded, divide the two. He actually thought in the beginning that it would be a positive indicator, but it's not. It's a contrary indicator. So for our purposes, we use the equity-only put-call ratio. That's all stock options that trade to predict the broad market. I'll show you that in a minute. But essentially what Marty discovered was that if a lot of people are buying puts and it gets to be an extreme, then you got to think the market's going to, you know, head higher. So you would do something bullish. On the other hand, if everybody's buying calls, everybody's all bullish, then you probably need to be doing something bearish. So figuring out what too much means is, of course, the crux of the matter. And let's just take a quick example. Let's say it's IBM. This is just a standard put call ratio, so we're just using the volume. So we sum up the volume of all the puts that traded today in IBM and separately sum up the volume of all the calls, divide the two, and that is the put call ratio. So since puts are in the numerator of the fraction, heavy put buying generates higher numbers for the ratio. But, you know, when are you likely to get, you know, heavy put buying? Well, that's when the stock is going down. So they move in opposite directions to each other. The same thing with call. Call buying is in the denominator. So when the denominator of a fraction increases, the fraction drops in value. So the ratio would be going lower when there's heavy call buying, but heavy call buying would most likely be taking place when the stock is going up. So again, moves opposite to each other. We keep a moving average. I use 21 days just in case there's something to Fibonacci. And before we actually look at today's data, I just want to show you that this symmetry should exist. We publish, as part of what we call the strategy zone on our website, we publish over 1,600 put call ratio charts every day. And we put the stock price as well as the put call ratio so that you get an idea what's going on. But here, let's just say, as an example, this stock is going down. So the put call ratio would be going up. People are buying puts, forcing the ratio higher. But eventually the put call ratio rolls over and forms a local maximum. And so a local maximum is a buy signal for the stock. So that equates to a buy signal up here for the stock. So in the theoretical world, the stock starts to move higher. So move over to the left side, stock's still moving higher. And as the stock is moving higher, the put call ratio is moving lower because people are buying calls when the stock is rallying. But eventually you get down here and you get a local minimum. And so a local minimum in the put call ratio is a sell signal for the stock. So that's the theory. That's how we interpret it. If you look at a put call ratio chart and you don't see this symmetry, then other things might be going on that distort it, like arbitrage, dividend arbitrage, or takeover arbitrage, or something like that. So it pays to look not only for the symmetry, but require the symmetry. This is not a current chart, but on top is the S&P 500, and the bottom is the equity-only put-call ratio. Again, all stock options that trade. And as I said before, we use that to predict the stock market because you can see the inverse symmetry that exists here most of the time. All right, enough of that. Here's the actual current ratio. So we got a great buy signal, a local maximum here in April after that bottom, and basically we had a little blip upwards here, which was really a failed sell signal, but it quickly reversed and went right back down again. So now we're trading at new relative lows. We're pointing downwards. As long as it's declining, that buy signal is still in effect. Eventually somewhere it'll roll over like that and we'll get a sell signal, but I don't know exactly where that's going to be. We have computer analysis programs that look at these in sort of the same way that you look at a chess playing tree. You look out a few moves or here a few days, and you know what kind of put call ratios are coming off the 21-day moving average, and you can sort of make the assumption that the ones going to be coming on are near the ones you're seeing right now. And so a lot of times, just as it rolls over just for a day or two, the computer programs will verify a signal as taking place. So you don't have to wait for a long time to wait to see that thing roll over. The computer analysis will tell you pretty quickly. And you can see here the red letters are generally positive signals where we made money. The two blue sales were quickly reversed backwards, but those were not great sales. As also, you can see we had a nice sell signal back in February before the market collapsed. Just as a way of, excuse me, what do I didn't mean to advance that yet. The very bottom of the screen, it says it's the lowest since November 21. It's referring to this reading back here in December, right there. And that was the lowest since 2021, but the ratio has been much lower than that at other times in the past. And as I said before, we look for local maxima, local minima, not the absolute value of the ratio. Now, as computers got involved in things, we were able to do more complex calculations. And one of those is the weighted put call ratio, or dollar weighted put call ratio. So the way we do it is that at the end of every day, we take the option price and multiply it by the option volume. You could do that on a tick by tick basis, but we don't. We tried it that way. It burned up a lot of computer power. It didn't really give us any better signals. So we do it this way. So now we make that calculation for every option. Let's say again it's IBM, and then we do the sum of those dollar volumes for all the puts, separately sum for all the calls, divide the two, and now we've got well, essentially the ratio of dollars being spent on puts versus dollars being spent on calls. This ratio surprisingly gives signals at about the same time as the other ones, but they're often more extreme, a little bit easier to see on the chart and what have you. So we generally concentrate on the weighted dollar put call ratios, both for the broad market and for the individual stocks. So here's the current equity only weighted put call ratio. You can see the same thing. We had this decent buy signal here in April, the good sell signal back in February, and then it rolled up prematurely and quickly reversed back to a buy signal, and now it's dropped to a new relative low. This chart was updated through last night, and so it dropped to a new relative low. So that is still on a buy signal. It's in overbought territory because it's so low on the chart, but we will not try to anticipate a signal. It could go much lower. I mean, in theory, it has happened in the past. So as long as it's trending down, that's positive for the stock market. So that slide just basically summarizes everything I've just been saying. When you get the PDFs of the presentation, when they get emailed to you, you can find these summary pages rather than trying to remember exactly what I said. So what do we trade when we trade these signals? So if we're looking at the MVB, McMillan Volatility Band signal, or this equity only put call ratio signal, we're trading the broad market. So we trade SPY options or sometimes E-mini futures options. They work just as well. And we're looking to buy a slightly in the money option. I just wrote an article last week, in fact, about I was getting a little too cute about some out of the money options. I thought the market, once it broke to a new high, was really going to fly, and I didn't make as much as I would have with the in the money options. So we'll look to buy, let's say, a SPY option, 1 or 2 strikes in the money, which is something with a delta of 60 or 70, meaning that it moves about 60% as fast as the stock does. And so if we're right about the underlying SPY going higher, then the option should go higher too. I don't want to be in the situation where I'm right about the direction of SPY, but I lost because I picked the wrong option. So if you're buying an in the money option or even an at the money option, you don't have to worry about that. Sometimes if we're looking at a put call ratio, I'll go out a little bit farther, and therefore just to limit risk to a smaller dollar amount, we'll buy an at the money option. Now, a lot of times on TV, you'll see the option traders, the option programs or whatever you want to say, use a bull spread. And by bull spread, what they mean is that if you're bullish on this stock, you buy a call at this strike, and you sell a call at this strike. So you're good as long as the stock is moving between the 2 strikes, you're making money. But once it gets to the higher strike, you've cut off your profit potential. And that's not a good thing. I mean, I just don't see why you'd want to do that. So you can work through the theory or whatever, but if the implied volatilities of the options are high, and we have free volatility data on our website, so you can look at the implied volatility percentile of anything that trades options, any futures, any stock, any index, any whatever, ETF. So if their options are expensive, then a bull spread might make sense. But if they're just normal, there's really no reason to cut off your profit. Now, the proponents of the spread will say, well, you're risking less, but you're not. That's a false statement. You're risking 100% of what your broker asks you to put up, no matter which strategy you use. So if you buy calls, you put up 100% of the value of the call, and it's at risk. If you buy the bull spread, you put up 100% of the value of the spread, and it's all at risk. So that's not the case. Dollars, yes, you might save yourself a few dollars by doing the spread, but then you don't have this work that could possibly work for you. I mean, I'd say like almost every year of my trading life, I've had a couple of trades that just really ripped to the upside. And if you've cut off your profit potential, then it's a lot of work to try to keep up with that thing. But I'm going to show you how to do that anyways. But here in this case, so maybe instead of buying 5 bull spreads, you would only buy 4 long calls or something like that if you're really worried about your total dollar risk, and then you still have the upside working for you. So there's two ways to mitigate the negative aspects of those bull spreads. The first is to widen the difference in the strike. So right now, SPY has dropped, VIX is dropping, the volatility of SPY calls has been dropping. But even so, if we're going out past August 1st, say in the middle, August 15th, for example, we're going to probably still spread the SPY calls, and I would spread them 15 to 20 points apart. If you're trading puts, though, because puts are even more expensive than calls, you would spread those 25 to 30 points apart. So that's the first thing you can do to help yourself out. And the second thing you can do is roll if the short strike is hit. What I mean by that, let me give you an example. Let's suppose today's S&P or SPY was around 620, and you set up the August 620, 640 bull call spread. And you were fortunate enough to see it trade up to 640. So if it trades up to 640, you sell this spread, take your profit, and instead you buy this new spread with the low strike of 640 and the high strike of 660. The reason being that's like once you hit that upper strike, there's not much left in it. I'm going to like redraw that profit potential. So if you started down here, it's fine, but now you're up here. And yes, there's a little bit of more money you could make in this bull spread, but not much. And so you've kind of made about all you're going to make from that 620, 640 call spread. But if you sell that one and set up a new one with a higher, profit potential, then you can keep going on the upside. As I said, it's a little more work to do this, but at least you don't have to just say, well, I'm done. You can keep with a trending bull trend in this case. Just as a side note, with interest rates where they are, about 4%, the call option prices are not all that favorable. That 620, 640 call spread is going to cost you $9.75. These prices were today. So you're paying $9.75 for something that could max out at 20. In option terms, that's really not all that great. But that's where it is right now. If you want it to be bigger than that, of course, you can raise the higher strike or not do the spread at all. On puts, if we're going to start out today, we'd buy at the money, the 620 put, and I'd sell 130 points lower. With puts, because of the way that options are priced with the log normal distribution, this put spread only costs 6 points, and it can max out at 30. So that's a lot better risk reward ratio for the spread. So the spread makes a lot more sense with puts than it does the calls. In any case, if S&P or SPY were to trade down to 590, your lower strike, then you would sell that spread to buy a new one with both strikes 30 points lower. So again, roll if the short strike is hit. I'm just going to show you a couple of put call ratio charts because I don't want to take up too much time on this. One that we've just gotten a buy signal in is Apple. You can see the put call ratio. This is the weighted put call ratio. Got up here and then gave us a local maximum. That's a buy signal at about the 240 level. What 240 means is that $240 is being spent on puts for every $100 being spent on calls. And you can see that back in May of 2024, we had about that same situation. We get a buy signal. You can see it had a nice move there. So we're hoping for something similar. You can do this with futures options too. Like this put call ratio right here. This is not a current chart, but I'm just using that as an example. That put call ratio right there is drawn using the options on the 10-year Treasury futures that trade on the Board of Trade. But you don't have to trade those futures. You can trade an ETF that simulates those futures. In this case, IEF would be one. But not every single futures contract has such a simulation. For example, if you're trying to trade soybean oil, here we had a local maximum. You can see actually they're all pretty good signals here. Soybean oil is $600 a point, so you don't need a lot of points to make some money in this sell signal here. But there are no ETFs on the stock side of the ledger that simulate soybean oil, so you'd actually have to go down the Board of Trade and trade soybean oil options, which means for most brokerage firms you'd have to open a futures account. If you're interactive brokers, you don't. You can combine it. Anyways, let's move on. Market breadth is a couple of things we can do with market breadth. One is to keep a cumulative total. We just every day we take advances minus declines and keep a running total of that. So we do that. And secondly, we can keep an oscillator. So our oscillators are defined as today's oscillator value is 90% of yesterday's value plus 10% of the difference between today's advances and declines. Now, there's two things that we use. First, of course, we use New York Stock Exchange breadth. Everybody uses that. And so since it's the standard, we do too. However, a lot of things on the New York Stock Exchange are not stocks. And even though they publish an operating company's index data, we have a better stocks only, we call it, as I'm just going to abbreviate it here, SO, stocks only. All stocks that have listed options on them. There's over 6,000 of those now. So we keep an advanced decline line and an oscillator using that. And here is the oscillator of the stocks only oscillator going back to 2018 here on the left side. You can see a few times in history it's been really oversold at 2018 right before Christmas. The very bad market. That's of course the pandemic. This was the end of the 2022 bear market, and this was just last April. So again, those are extreme oversold conditions. As we said before, oversold does not mean buy. But when it stops being oversold, we do buy. And so that buy signal right there came in at April 22nd. We moved up here above the red line. That puts us in overbought territory and came back out. And there was a sell signal right there that was generated, but it was quickly canceled out. We've moved now to a high right there. That's where it is right now, well, as of yesterday's close. So the oscillator is quite overbought right now, but I'm not too worried about that because, as I said before, with S&P making new all-time highs, to have an indicator like this be that overbought is okay. This has a spotty track record, I'm just going to say, because it can swing back and forth pretty quickly. But again, we trade with options, so we know what our risk is. And you know, when it gets it right, you have some very strong gains in a pretty short period of time. So the breadth oscillators are on buy signals right now. Again, in overbought territory, a little bit like I would say the put call ratios are in overbought territory by being low on their charts. So another thing I said we can keep a cumulative total. We keep a cumulative total of volume breadth. In other words, breadth on advancing issues minus breadth on declining issues accumulated daily. We keep that again for both New York Stock Exchange data and stocks only data. So it turns out there's two uses of this. One, there's predictive value. This sometimes will make a new all-time high well before the S&P does. And typically the S&P comes along and does the same. So that just happened. I'll show you that chart in a minute. But it also at tops, you can sometimes get a negative divergence. Now we don't have any negative divergence right now because it just made a new all-time high again last Friday on the 23rd, on the 3rd. And not every bear market starts with a negative divergence anyways, but the one in October in 2022 did. So that's a thing we typically look for. But here's what I was talking about. This is right here in May 16th actually was the date this happened. Cumulative volume breadth went to a new all-time high. You can see it's back to a new high. But at that time, S&P was still down around 5,700 or so and had not yet made a new all-time high. So we bought calls at that point and have ridden that all the way up. And I'm still considering that to be a positive indicator because the cumulative volume breadth is still making new highs. Another thing we keep track of, new highs versus new lows. There's three ways to look at this. One is with New York Stock Exchange data. That's the leftmost column. We can also do it with our stocks only data, and we can also do it with NASDAQ data. So we look at all three, but it's this one that the New York that we use as a signal. Over here is the various signals. It gave a sell signal in late March, which was stopped out in late April. That made some decent money. And then it sat dormant for a while, but just now recently on June 27th gave a buy signal. So this is also bullish right now. The data shown here doesn't go all the way to June 27th, but So that indicator is also bullish. So let's look at the VIX indicators. This is pretty interesting, and I think a lot of times people misunderstand VIX. So the trend of VIX is important. It should be trending opposite to the market. Sometimes when panic hits, VIX spikes up and back down. Those are buy signals for the stock market. And then the third thing, and this is sort of where we are now, when VIX is low, the market's overbought. And, VIX is low right now, 16-ish. But it's not really a problem until VIX begins to rise. So we've had cases in the past, like, 2006 was one, 2016 was one, 2019. The market just keeps going and VIX just keeps staying lower. So to get out of the market just because VIX is low would be a wrong thing to do. You wait till see it begin to rise, then you get out or do some active protection. So this is a 1-year chart of VIX. The spike peaks are all those B's all over the place, those that are buy signals. We have a system that we trade based on that, and it most recently gave a buy signal here in late June, and that's still in effect. It lasts for about a month, so it's still got a couple of weeks to run. Meanwhile, the trend of VIX we define as where the 20-day and VIX crossed the 200-day. That was one right there. So that's a buy signal because they both crossed below. This over here was a sell signal and they both crossed above. So that's that sell signal. You can see another sell and buy on there. So we keep track of all those things and we keep up to date in the newsletter. But right now, this buy signal that occurred, really in very early June is still in effect because the 20-day moving average of VIX has remained below the 200-day all throughout that time. Now, if the 20-day were to move back above the 200-day, that would be a sell signal, but that's not going to happen anytime very soon. Now, you can't, so that just summarizes those things. You can't trade VIX itself. You can trade VIX futures and VIX options, and they're a little bit different. But so the one thing we look at on VIX futures, typically as you look out in time, they should be trading at slightly higher prices like that. When you see that term structure slope upwards like that, that's bullish for stocks. Occasionally, though, this happens. You get a negative slope to the term structure. That's not good. And that happened in April of this year. You saw some of the really nasty selling that took place at that time. So here's the current structure as of 3 o'clock this afternoon. VIX is trading at 1578, and the front month July futures were at 1705. So we take 1705, subtract 1578, and we get 127. So there's a premium of $1.27, and that's fine. You can see here that each of these futures is trading a slightly higher price than the previous one, except for November, December. So the term structure is sloping higher, and they're all trading at a big fat premium to VIX. And again, that's bullish. So these are pretty much bullish things. We have a trading system based on this premium, and it's long right now. If you don't trade the futures, you can also just look at the CBOE volatility indices. They publish 6 indexes. There's a 1-day, a 9-day. VIX is a 30-day, 3-month, 6-month, and 1 year. Again, when we look at these prices of these this afternoon, you can see each one is higher than the other. So the term structure is sloping higher. That's bullish too. So a lot of bullish indicators here. I'm sorry, I went the wrong way there. So overall, this is bullish. The number one thing I'd say just to monitor is the 2 front month futures prices. The CBOE on their futures website has delayed prices, but right now July's at 1705, August is at 1925. That's a big premium, so no worry there at all. But if July were to rise and start to trade higher than August, then you would become worried. And so the last time we saw anything like that was April, but prior to that, we really hadn't seen it much since the pandemic back in March of 2020. Another thing that I wrote an article about this, and if you become a subscriber to the Option Strategy, you'll have access to these back articles. But occasionally you look at the difference between VIX and the historical, realized volatility of the stock market. So VIX is, the VIX minus historical volatility of the S&P 500. Occasionally, the historical volatility gets way ahead of VIX, and that happened, in April, right during as the pandemic was ending, and it happened over here. It most recently was in early May. And then so that's a warning sign, it's deeply oversold market. And when it gets back above here, you get a buy signal. So that gave us a buy signal on May 8th, and that's still essentially in effect too. We're running that with a trailing stop, but it was a really strong and nice buy signal. Another thing we look at is the frequency of 90% days, 90% up volume, 90% more advances than declines, or 90% more declines than advances. Either one works right now. There's been 4 in the last 50 days. So that's, numerous, but nothing crazy. But you can see that in a really bearish time, this number jumps very high. So we're watching that. If that starts to increase even more, then we would become concerned. Right now, it's just sort of an overbought warning sign. So where do we stand? So here's all the indicators. We have nothing that's bearish right now. And the only thing that was neutral was we don't have an MVB signal. Next one will be a sell signal. All the rest of those are bullish, and they're just about as bullish as you get. Maybe the constructive volatility derivatives could have a little bit steeper term structure, so I didn't push that all the way to the left-hand side there, but everything else is pretty much max bullish. Now, max bullish does mean overbought in some situations, but we don't consider overbought to be a sell signal. So we're waiting, and when that rolls, we'll act on. But right now, with our indicators like that and S&P at a new all-time high, it's pretty easy to say we're bullish. And so we've been bullish for a while. We're still bullish. What we do is, though, when options get deeply in the money, we roll them. And if you want a definition, that's 8 points on a SPY option. So if you buy an at-the-money SPY option, it gets 8 points in the money, roll up, sell that one, and buy the new at-the-money. And that keeps you, generating credits on the way up, but you're still participating on the way up as well. Eventually, the last buy, of course, will be a loss, but hopefully you had a series of winners on the way into that one. So back to the offer. As I said, we will email you the PDFs in the next day or two. You go to this website, though, and you can access this offer. So we have our 3 top newsletters, all 3 of them combined $99 for 1 month. And so that's the daily volume alerts, which I write every morning, and has all these systems in it that we've been talking about. The option strategist, which is our oldest newsletter, in its 34th year of publication, comes out once a week. And then the daily strategist comes out twice a day. So that's a chore. But if you want to look at these, I would suggest doing them consecutively rather than all at once, concurrently. Consecutively, at least you have a chance to see how they are working for you. So we have this should be 34 there. We have the track record on the website for both the option strategies. Well, really for all 3 of these. Again, just because we've been doing well in the past doesn't mean we'll do so in the future, though. We also have a YouTube channel if you want to subscribe to that, and a couple of other newsletters too. If you're more into just like, say, writing puts, we have that newsletter as well. Again, they're all accessible through that website, but the discount is only accessible through there. So that's basically it. If you're interested in money management, you can visit that website. Our minimum account size is $100,000.